Anyone with a job or business should know that the money that comes into the business should be more than the expenses it takes to run a business. When a business's expenses are subtracted from its revenue, what is left over is the business's net income. In the perfect world, the net income should be a positive number. If expenses are more than revenue, the result is a net loss, and no one wants to see a loss. So how do we determine the net income for a business? It's easier than you might think. All we need to do is subtract the debit column total from the credit column total on the income statement portion of the worksheet. If the business revenue less the total expenses equals a positive number, there's a net income for the business, and that's a very good thing. To complete the net income portion of the worksheet, you will skip a line below the last entry under the account name column, then write the words net income. Next, you will write the amount of the net income in the debit column of the total statement on the worksheet. Write the amount of the net income in the credit column of the balance sheet on the worksheet. I bet you're asking why. Do you remember that revenue and expense accounts are temporary capital accounts? Net income increases capital. Revenue and expenses are recorded in temporary capital accounts for the accounting period. Revenue is posted to the owner's capital account at the end of an accounting period. On the balance sheet, the owner's capital account is increased by credits. To show net income on the balance sheet, the net income amount should go in the credit column on the balance sheet. Once you have added the net income, the next thing you will need to do is check the balance. To do this, you will need to subtract the total debits from total credits on the income statement. Subtract total credits from total debits on the balance sheet. The difference between the two numbers should be the same. If the numbers are different, you've made a mistake and need to look for it.